You're staring at your screen at 2 a.m., refreshing your portfolio for the 100th time tonight. Bitcoin hit $109,000 just 4 months ago in December 2025. You saw the headlines. Institutional adoption is here. Bitcoin ETFs changing the game. This time is different. So you bought in. Maybe at $95,000. Maybe at $88,000. Maybe you waited until what you thought was a dip at $82,000. Doesn't really matter now. Bitcoin is currently sitting around $72,000, down 36% from the peak, down from wherever you bought it. And you're asking yourself the same question everyone's asking. If BlackRock's ETF holds over $25 billion, if Michael Saylor keeps buying billions more, if every smart money indicator says institutions are accumulating, why the hell is the price collapsing? What am I missing? What do the big players know that I don't? Here's what you're about to discover. The uncomfortable truth about how massive financial institutions can legally crush the price of assets they actually want to own, why the biggest Bitcoin holder in corporate America might be walking into a financial trap that could force them to dump billions in Bitcoin at the worst possible time, and most importantly, how understanding this changes everything about how you should think about the price action you're seeing right now. By the end of this video, you'll understand financial mechanics that most retail investors never learn, and you'll know exactly what to watch for in the coming months that will tell you whether this is coordinated suppression or just brutal market reality. But let me be absolutely clear before we go further. I'm not a financial advisor. This is not financial advice, and I'm not telling you what to do with your money. I'm showing you publicly available information and historical patterns so you can make your own informed decisions. If you need personalized investment guidance, talk to a licensed professional who understands your specific situation. If you want to understand what's really happening in markets while everyone else is just watching price charts and bleeding money, smash that subscribe button and hit the like. This is going to challenge everything you think you know about how markets actually work. My name is Bryson, and I spend way too much time digging into why assets don't move the way they're supposed to. And what I'm about to show you isn't conspiracy theory territory. It's documented financial history repeating itself in real time. And the pattern is so clear it's almost terrifying. Let me start with a story that seems completely unrelated, but stay with me because this is the foundation for understanding everything that's happening right now. In 1982, Mexico borrowed tens of billions of dollars from international banks. The money was supposed to fund infrastructure, economic development, building the future. Smart move, right? Except there was one critical detail that would destroy them. That debt was denominated in US dollars, not Mexican pesos. Why does that matter? Because Mexico can't print US dollars. They don't control the supply. They can only earn dollars through exports or borrow more. They're completely dependent on a currency someone else controls. So when the U.S. Federal Reserve cranked up interest rates in the early 1980s to fight inflation, something devastating happened. The dollar got stronger. The peso got weaker. And suddenly Mexico's debt payments exploded overnight. They owed $80 billion with absolutely no way to pay it back. Enter the IMF, the International Monetary Fund, with what they called a rescue package. But here's what that rescue actually meant. Mexico had to privatize state-owned companies, slash social programs, open their markets to foreign corporations, basically sell pieces of their country at fire sale prices to pay back the banks. This wasn't unique to Mexico. The exact same pattern played out in Argentina, Brazil, Indonesia, dozens of countries over the following decades. Borrow in currency you don't control, get trapped when conditions change, forced to sell assets at terrible prices. Now you're probably thinking, Bryson, what does 1980s Mexico have to do with Bitcoin at $70,000 in 2026? Everything. Because what I just described is called a debt trap. And the psychology behind it doesn't just apply to countries. It applies to companies. And right now, there's a company holding over $33 billion worth of Bitcoin that's structured in a way that makes them potentially vulnerable to the exact same trap. Let me give you a simpler example to make this crystal clear. Imagine you own a house worth $400,000. You take out a home equity line of credit for $80,000 at a variable interest rate. Right now, rates are reasonable, so you're paying maybe $350 a month. Totally manageable on your income. But then interest rates spike. Suddenly, you're paying $800 a month, then $1,100, then $1,400. Your income hasn't changed, but your payment has tripled. What are your options? You can sell the house, but maybe the market's crashed and you take a massive loss. You can refinance, but that means taking on even more debt at worse terms. Or you default and the bank takes everything. Here's the psychological trap. The moment you start panicking about making payments, you make desperate decisions. You might sell at the worst possible time just to avoid default. You might accept terrible refinancing terms just to survive a few more months. And the whole time, the bank that lent you that money is sitting there knowing you're cornered, knowing you're desperate, knowing they have all the leverage. This is financial pressure without financial crime. The bank didn't do anything illegal. They just created a structure where when conditions change, you're trapped and they control your fate. Now scale that up. Instead of a $400,000 house, imagine it's $33 billion worth of Bitcoin. Instead of an $80,000 home equity line, imagine it's over $7 billion in convertible debt. And instead of some random homeowner, imagine it's a publicly traded company whose stock price determines whether they can keep their Bitcoin or have to start dumping it into the market. That company exists. It's called MicroStrategy. And what's happening with MicroStrategy right now, as Bitcoin crashes from $109,000 to $70,000, is the key to understanding why this entire market might be getting systematically crushed. So let's break down what MicroStrategy actually is, because on paper they're a software company that sells business intelligence tools. But that's not really what they are anymore. What they become is essentially a massively leveraged Bitcoin investment fund, disguised as a corporation. Here's how their structure works. MicroStrategy raises money in three main ways. They sell shares of their stock, they issue convertible bonds, and they issue preferred shares. Then they take essentially all that money and buy Bitcoin. As of early February 2026, they own approximately 471,000 Bitcoin. At today's price around $70,000, that's worth about $33 billion. But here's the terrifying part. They paid roughly $31 billion total for all that Bitcoin. So with Bitcoin at $70,000, they're sitting on only about $2 billion in unrealized gains. That cushion has evaporated as Bitcoin crashed from $109,000. And here's where it gets dangerous. Those convertible bonds and preferred shares come with mandatory obligations. The bonds require interest payments. The preferred shares require dividend payments. And unlike regular stock dividends that a company can just skip if times are tough, preferred dividends are mandatory. If you don't pay them, you're in default. Right now, MicroStrategy owes approximately $88 million annually just to service their debt and preferred dividends. That's over $240,000 every single day that has to go out the door no matter what Bitcoin's price is doing. Where does that money come from? Their software business generates maybe $30 to $50 million in free cash flow annually. That's nowhere near enough to cover their obligations. So they've built up a cash reserve specifically to cover these payments. At current burn rates, they've got maybe 18 to 24 months of runway before that cash reserve runs dangerously low. And this is where we are right now in early 2026. The trap is tightening. Let me explain the precarious position they're in as Bitcoin sits at $70,000. MicroStrategy stock needs to trade at what's called a premium to net asset value for their entire strategy to work. Here's what that means. If you take the value of all their Bitcoin at $70,000 per coin, subtract all their debts, you get their net asset value per share. Let's say that works out to roughly $200 per share based on current Bitcoin prices. But for MicroStrategy to keep buying more Bitcoin, their stock needs to trade significantly above that $200. Maybe at $280 or $300 per share. That premium is everything. Because as long as the stock trades at a premium, MicroStrategy can keep selling shares to raise cash. They sell $500 million in stock, use it to buy more Bitcoin. Bitcoin eventually goes up, stock goes up, they sell more stock, buy more Bitcoin. It's a beautiful flywheel that works perfectly until it breaks. And right now, with Bitcoin at $70,000, that flywheel is grinding to a halt. Here's the crisis. As Bitcoin crashed from $109,000 to $70,000, MicroStrategy's stock has been absolutely hammered. At various points in recent weeks, the stock has traded below or barely above their net asset value. The premium has vanished. When that premium disappears, everything falls apart. Suddenly, MicroStrategy can't sell shares anymore. Because selling shares when your stock trades at or below the value of your Bitcoin would be like selling your Bitcoin at a loss or breaking even. It makes no financial sense. So equity raises stop working as a funding mechanism. Now that cash reserve is the only buffer between them and a full-blown crisis. And remember, they're burning through about $240,000 daily in obligations. They've got maybe 18 to 24 months of runway, and that clock is ticking. And here's where the death spiral becomes terrifyingly real. If they start having to sell Bitcoin to meet their payment obligations, what happens to Bitcoin's price? It drops further. And if Bitcoin drops further, what happens to MicroStrategy stock? It drops even more. And if the stock drops more, they need to sell even more Bitcoin to raise the same amount of cash. This is the death spiral everyone's terrified of, and we might be watching the early stages of it unfold right now. Now you're probably thinking, okay, Bryson, but why would anyone want this to happen? Why would institutions try to push MicroStrategy into this corner when Bitcoin crashing hurts everyone? Here's where the psychology gets dark, and this is where understanding history becomes absolutely critical. Imagine you're a major investment bank. You have wealthy clients, pension funds, endowments, sovereign wealth funds, all wanting Bitcoin exposure. But these aren't retail investors panic buying on Coinbase. These are massive institutions with strict rules about what they can invest in. Many of these institutions can't just buy Bitcoin directly on exchanges. Regulatory concerns, custody issues, volatility risks, compliance headaches. But what if there was a way to buy massive amounts of Bitcoin at a huge discount? What if instead of paying $70,000 per Bitcoin on the open market, they could effectively acquire it for $55,000 or $58,000? Here's how that works. If MicroStrategy gets pushed into financial distress where they absolutely have to sell Bitcoin to survive, they won't sell it on public exchanges. That would crash the price and they'd get terrible execution. Instead, they'll do what's called a block trade. They'll call up a few major investment banks privately and say, we need to sell $2 billion in Bitcoin immediately. Who wants it? And those banks will say, sure, we'll take it, but we need a 15% to 20% discount because we're absorbing this much volume and taking on the risk. So suddenly these institutions can acquire billions in Bitcoin at $56,000 or $58,000 when the market price is $70,000. Then they turn around and either sell exposure to their clients at a markup or hold it themselves waiting for the next bull run. Either way, they've just bought massive amounts of Bitcoin on sale. But for this to work, MicroStrategy needs to actually be in genuine distress. They need the stock trading at or below asset value. They need that cash reserve running low. They need pressure building to the point where selling becomes inevitable. And how do you create that pressure? You short the stock. You publish negative research. You spread fear about the debt structure. You wait for Bitcoin to drop, and then you amplify the panic. Now let me be very clear. I don't have evidence of a coordinated conspiracy. I don't have recorded phone calls of bankers plotting this in a conference room. But I do have history. And history shows this exact playbook has been used before with devastating effectiveness. In the early 2000s, there was a financing structure called pipe deals, private investment in public equity. Specifically, there was a toxic variant called death spiral convertibles or floorless convertibles. Here's how they worked. A struggling company desperate for cash goes to a hedge fund. The fund says, we'll give you $10 million, but instead of paying us back in cash, you pay us in stock. And the lower your stock price goes, the more shares we get. Think about the incentive structure there. The lower the stock price falls, the more shares the lender receives. What's their motivation? To absolutely crush the stock price. How do you do that? Short the stock aggressively. Spread fear in the market. Create panic among retail investors. The SEC investigated hundreds of these deals in the early 2000s. What they found was absolutely devastating. Companies that entered these agreements saw stock prices fall an average of 34% within a year. About 85% had negative returns. Nearly half were completely delisted, destroyed, wiped off the map. Real companies. Real shareholders who lost everything. And it was perfectly legal. Now, MicroStrategy doesn't have death spiral convertibles. Their debt structure is different, but the psychological dynamic is eerily similar. If you're a hedge fund or investment bank and you believe MicroStrategy will eventually be forced to sell Bitcoin, what's your optimal play? Short the stock. Apply relentless pressure. Wait for the inevitable. Let me show you how real this concern is with actual numbers from right now in early 2026. With Bitcoin at $70,000, MicroStrategy's entire market capitalization has at times traded below or barely above the value of just the Bitcoin they own. Think about that absurdity. You could theoretically buy MicroStrategy shares and effectively get Bitcoin at a discount compared to buying Bitcoin directly, but you'd also inherit all their debt and all their risk. Why would the market price it this way? Because the market is pricing in the very real risk of the death spiral. The market is saying, yeah, you own all this Bitcoin, but you also have all this debt, limited cash runway, and if Bitcoin keeps dropping or stays depressed, you're going to have to sell. And when you do, everyone holding your stock loses. During the same period in late 2025 and early 2026, we've seen massive short interest in MicroStrategy stock. Billions of dollars in short positions. Some prominent hedge funds have publicly announced they're betting against the company. Major investment banks have published research reports questioning the sustainability of the model, highlighting the risks, noting that if the stock falls far enough, it could get kicked out of major indexes, which would force passive index funds to automatically sell, pushing the price down even further in a self-reinforcing collapse. Is any of that illegal market manipulation? No. Publishing bearish research is protected speech. Shorting stocks is completely normal and legal market activity. But the net effect is massive pressure on a company that's structurally vulnerable to exactly this kind of pressure. Here's what most people don't understand about modern financial warfare. You don't need to do anything illegal. You just need to understand the incentive structures and exploit them with precision. It's like playing poker. You don't need to cheat. You just need to know when someone's in a desperate position and apply pressure at exactly the right moment to force them to fold. Think about it from Michael Saylor's perspective right now in early 2026. He's the CEO of MicroStrategy. He's built his entire reputation on the Bitcoin thesis, and he's watching his stock get absolutely destroyed by short sellers as Bitcoin crashes. What are his realistic options? He could try to keep buying more Bitcoin to show confidence, but that only works if he can raise capital, which only works if the stock trades at a premium, which it doesn't right now. He could try to raise more money by selling shares, but that dilutes existing shareholders and doesn't work when the stock trades at or below asset value. He could try to pay down debt to reduce obligations, but that requires selling Bitcoin, which is the last thing he wants to do and would signal panic to the market. He's trapped in a corner with no good moves. And the people shorting his stock know he's trapped. They're not hoping Bitcoin fails long-term. They're betting on a specific short-term outcome, that eventually the financial pressure becomes too much and MicroStrategy is forced to sell billions in Bitcoin at exactly the wrong time, which proves the bear's thesis and makes them massive profits. This is the dark part that nobody wants to talk about openly. This isn't about Bitcoin being fundamentally flawed. This isn't about the technology failing or adoption reversing. This is about financial structures being weaponized against the largest Bitcoin holders to force them to sell at distressed prices. Now, the obvious question everyone's asking, if this is true, what should you do? Because I know some of you are thinking, great, Bryson, now I'm absolutely terrified. Should I sell everything right now? No. Here's why understanding this dynamic makes you smarter, not more scared. First, recognize that MicroStrategy is not Bitcoin. Bitcoin is a decentralized protocol with no CEO, no debt, no equity structure. MicroStrategy is a company with a specific capital structure and specific risks that are completely separate from Bitcoin itself. If MicroStrategy gets into trouble, that doesn't mean Bitcoin is broken. It means one company made specific financial decisions that created specific vulnerabilities in a brutal bear market. Second, this pressure actually reveals something critically important. Major institutions want Bitcoin. If they didn't believe in long-term value, they wouldn't bother with these complex financial maneuvers. They just ignore it completely. The fact that there's all this sophisticated pressure, all this maneuvering, all these short positions, tells you that smart money believes Bitcoin is valuable long-term. They just want to acquire it as cheap as possible during moments of panic. So if you're a long-term holder who believes in the fundamental thesis, the absolute worst thing you can do is panic sell during manufacturer pressure. That's exactly what institutions want. They want you to sell your Bitcoin to them at $70,000 or $65,000 or $55,000 so they can accumulate massive positions and then sell exposure to their clients at $120,000, $150,000 when the next bull cycle comes. Third, pay very close attention to time frames. MicroStrategy has roughly 18 to 24 months of cash runway at current burn rates. That's a countdown clock, and markets absolutely hate countdown clocks. The closer we get to that deadline without Bitcoin recovering, the more violent the volatility will become. But here's the key. If Bitcoin's price recovers significantly before that deadline, if MicroStrategy can successfully raise more capital, if they can refinance their debt on better terms, if market conditions improve, the whole death spiral thesis completely falls apart. The shorts get crushed and have to cover at higher prices. Let me give you specific numbers to think about your own situation. Say you bought Bitcoin at $88,000 back in late 2025. You put in $10,000, so you own about 0.114 Bitcoin. Now it's early 2026. Bitcoin is at $70,000, and you're down about $2,000 or 20%. You're watching all this MicroStrategy drama unfold, and you're terrified. Should you sell and cut your losses? Here are the two scenarios and how they play out. Scenario 1, you panic. You believe the death spiral is inevitable. You sell at $70,000, locking in your $2,000 loss. Then let's say the pressure intensifies over the next few months. MicroStrategy really struggles. Bitcoin drops to $52,000. You feel smart for selling and avoiding further losses. But you're completely out of the game with a realized $2,000 loss. Now imagine 6 to 9 months pass. The pressure finally resolves somehow. Maybe MicroStrategy successfully refinances. Maybe a major institution buys them out. Maybe Bitcoin ETF inflows accelerate. Maybe macro conditions improve. Short sellers are forced to cover their positions. Bitcoin rallies hard to $115,000. You're sitting on the sidelines, watching in agony, having locked in a loss and missed the entire recovery that you waited months for. Scenario 2, you understand the game being played. You know institutional players are trying to accumulate at lower prices during panic. When Bitcoin drops to $52,000 and everyone's screaming that it's going to $30,000, you don't panic. You actually buy more. You put in another $5,200 and now you own about 0.214 Bitcoin total. 6 to 9 months later, same resolution. Bitcoin recovers to $115,000. Your 0.214 Bitcoin is worth $24,610. You put in $15,200 total. You made $9,410 in profit. Same exact situation, completely different outcome based purely on understanding what's happening and managing your psychology during the storm. This is exactly how wealth transfers happen in markets. Not through scams or insider trading. Through psychological pressure applied at massive scale. Retail investors panic and sell at the bottom. Institutions accumulate during the fear. Then when prices eventually recover, retail investors feel like they missed out while institutions made fortunes. Let me tell you a story about something eerily similar that happened in the gold market that proves this isn't conspiracy theory, it's documented history. In the late 1990s and early 2000s, central banks around the world started aggressively selling their gold reserves. The Bank of England famously sold over half of Britain's gold reserves at an average price of around $275 per ounce between 1999 and 2002. The financial media mockingly called it the brown bottom after Gordon Brown, the finance minister who authorized the sales at the worst possible time. Why would they sell? The official public reason was that gold was an outdated relic, that it didn't generate any income or yield, that holding dollars or government bonds was smarter modern portfolio management. But here's what happened next. Over the following 20 years, gold went from $275 to over $2,000 per ounce. The Bank of England lost tens of billions of pounds in potential value by selling at the absolute bottom. Now here's the uncomfortable question that conspiracy theorists ask. Were those central bankers really that stupid and incompetent? Or were they coordinating with private banking institutions who wanted to accumulate gold cheap before the next major bull run? Central banks sell and create panic, price crashes, private money accumulates at huge discounts. Then price recovers over the following decade. Can I prove coordination happened? No, but the pattern is undeniable. Institutional sellers create massive pressure. Prices collapse. Smart money accumulates at the bottom. Prices eventually recover. Original sellers look foolish or corrupt while accumulators make generational fortunes. Is the exact same playbook being run right now with Bitcoin through pressure on MicroStrategy? I don't know for absolute certain, but the incentive structure is identical. The mechanism is proven to work. The historical precedent is clear. So let me give you concrete action steps. Here's what you should actually do with this information right now in early 2026. 1. If you own Bitcoin, do not panic sell based on short-term price crashes. Yes, it's painful watching your portfolio bleed. But the question isn't whether Bitcoin will drop another 20% or 30% from here. The question is whether the fundamental long-term thesis has changed. In my view, nothing fundamental has changed. Governments are still printing unlimited money. Bitcoin is still absolutely scarce. Institutional adoption is still growing despite the price action. The ETFs still exist and are still accumulating. 2. Watch MicroStrategy's quarterly earnings reports like a hawk. They publish extremely detailed information about cash reserves, debt obligations, and Bitcoin holdings. If you see that cash reserve actually running dangerously low, if you see them being forced to sell Bitcoin, that's a real signal that the crisis is escalating. But until that actually happens, it's just fear and speculation. Don't sell based on speculation. 3. Do not put all your money in Bitcoin or any single asset. Diversify across different cryptocurrencies, different asset classes, different strategies. If institutions are playing sophisticated games with Bitcoin through MicroStrategy pressure, they might be running similar plays elsewhere. Spread your risk intelligently. 4. And this is the most important point, educate yourself relentlessly on how financial markets actually work. The people who understand debt structures, short selling mechanics, net asset value calculations, convertible bonds, they have an absolutely massive advantage over people who just watch price charts and hope for the best. Knowledge is the only real defense. Here's what I want you to truly understand. The reason I spent all this time explaining debt traps in 1980s Mexico, death spiral convertibles in the 2000s, the gold manipulation playbook, and MicroStrategy's precarious structure today is because all these things are deeply connected. Financial engineering is just a tool. It can be used to build wealth, or it can be used to extract and transfer wealth. And the truly scary part is most people don't even realize it's happening to them. They just see their portfolio going down and think, I guess I was wrong about Bitcoin. I should have sold at the top. But you weren't necessarily wrong. You were potentially outmaneuvered by people who understand the game at a much deeper level and have vastly more resources. I'm not here to promise you Bitcoin hits $500,000 next year. I'm not here to guarantee anything about the future. What I'm here to do is show you the mechanics of how large institutions can apply crushing pressure to assets through completely legal means, and how understanding those mechanics can make you a dramatically better investor who doesn't get shaken out at exactly the wrong time. Because at the end of the day, successful investing isn't about being right about every short-term move. It's about understanding risk, managing your emotions, and having the patience and conviction to let long-term fundamentals play out while everyone else is panicking over short-term noise and manufactured fear. So what's going to happen with Bitcoin from here? I genuinely don't know the exact path. But here's what I do know with high confidence. If major institutions are engineering complex pressure campaigns to acquire Bitcoin cheaper through forced selling, that tells me they believe in enormous long-term value. If they didn't, they would simply ignore it completely. You don't engineer sophisticated financial attacks against worthless assets. You ignore worthless assets. You engineer attacks against assets you desperately want to own but don't want to pay full price for. So if you're scared right now, if you're worried about your holdings as Bitcoin sits at $70,000, ask yourself one fundamental question. Do you believe in the core long-term thesis? Do you believe a provably scarce, decentralized digital asset has enormous value in a world where governments print unlimited currency and debase their money supply? If yes, then short-term price manipulation and manufactured crises shouldn't change your strategy. It should create opportunity to accumulate more at depressed prices. If no, if you think Bitcoin is just pure speculation with no fundamental value, then honestly you probably shouldn't own it in the first place, because this volatility, this manipulation, this drama, it's absolutely not going away. This is the game. The only way to win is understanding the rules better than the people trying to take your money. So smash that subscribe button if this video helped you see what's really happening beneath the surface. Drop a comment and tell me if you think this MicroStrategy death spiral risk is real or if I'm connecting dots that don't actually exist. And most importantly, keep learning. Keep asking hard questions. Keep digging into how this system actually works. Because the absolute best defense against financial manipulation is education. Know what you own. Know exactly why you own it. Know when someone's running a sophisticated game trying to shake you out. I'll see you in the next one.